In 2021, ProPublica revealed the biggest tax secret in America. 25 of America's wealthiest people paid almost zero federal income tax. Jeff Bezos paid nothing in 2007. Elon Musk paid nothing in 2018. You'd think they're tax cheats or even criminals. What if I told you it was completely legal? Yes, sit tight. How do they even pay less tax than their own secretaries? The answer is hidden inside the 3 powerful strategies you'd never think of. Borrowing against assets, the stepped-up basis loophole, and trust mechanics. 3 tools, 1 quiet system, and almost nobody outside Wall Street fully understands it. By the end of this video, you will. Today, we break them all down step by step. Warren Buffett famously said a line that shocked many people, and I quote, "My tax rate is lower than my secretary's. That's just wrong." His secretary paid a higher tax rate than he did. That sentence alone contains a full education. The tax code does not treat all income equally. Wages are taxed hard, wealth is not. If you earn a salary, the government takes its share before the money even reaches your account. If you own assets that simply grow in value, the government often takes nothing at all. This single distinction shapes entire fortunes, entire dynasties, entire centuries of inherited power. Robert Kiyosaki wrote it plainly in Rich Dad, Poor Dad. The rich don't work for money, they make money work for them, and they understand the tax advantages of assets over income. The rich do not work for money, they build assets, and the tax system rewards that choice. This is written into law openly for anyone willing to read it. Understanding this is not about envy. It is more about getting financial literacy and informed citizenship. Because once you see the structure, you start asking better questions about your own money. Strategy 1 is called buy, borrow, die. Sounds dramatic, right? We know, yet remarkably effective. It begins with a simple act: buying appreciating assets, stocks, real estate, private businesses. Here is the first principle. You only owe tax when you sell an asset. If your stock rises from 1 million to 50 million, you owe 0 tax until you sell it. On paper, you are 50 times richer. To the tax authority, nothing taxable has happened yet. So the wealthy do something elegant instead. They borrow against the assets. A bank will lend you cash using your stock portfolio or real estate as collateral. These are sometimes called securities-backed lines of credit, and private banks compete to offer them. That loan is not income, it is debt, and debt is not taxed anywhere in the world. You now have spending power worth millions, and you have paid 0 income tax. You can buy a house, fund a business, or simply live, all on borrowed untaxed money. The loan interest, often deductible. The assets, still growing. The tax bill, deferred indefinitely. Even better, the interest rate on these loans is often lower than the asset's annual growth rate, which means the wealth grows faster than the debt does. The math quietly favors the borrower. This is what economists call the realization principle, and it is the bedrock of the strategy. It is the single rule that makes everything else in this video possible. Now, we arrive at the second strategy, and arguably the most powerful of the three. It is called the stepped up basis, and it is where the borrow strategy becomes permanent. Let us say a billionaire bought shares at $1 each. They are now worth $1,000. If they sell, they owe capital gains tax on that massive $999. But if they die holding those shares, something extraordinary happens under current US tax law. Their heirs inherit the shares at the current market value, not the original purchase price. That original gain, sometimes accumulated over decades, is completely and permanently erased. The tax liability disappears at death, the wealth transfers, and the cycle begins again. This is the death of the tax bill. Economists call it the angel of death loophole. It sounds almost poetic. In practice, it is one of the largest tax breaks in the entire code. Edward McCaffrey, a law professor at USC, described the full arc of this strategy. Buy, borrow, die. It is the perfect tax system for the already wealthy, one they did not have to design themselves. It was already waiting for them. Buy the assets, borrow against them, die holding them. 3 steps that preserves generational wealth. Notice what never happened in that sentence: a sale. And without a sale, there is no tax event. The third tool in this system is trust. It is the architecture that makes it all structural. A trust is a legal arrangement. You transfer assets to it. The trust owns them, not you personally. Because you no longer legally own those assets, they may fall outside your taxable estate entirely. One common vehicle is called the Grantor Retained Annuity Trust, or GRAT. You put appreciating assets into the GRAT, you receive fixed payments back over a set number of years. Any growth above the IRS hurdle rate passes to your heirs completely free of gift tax. If the asset doubles or triples in value, the excess belongs to the next generation, tax-free. Facebook co-founder Mark Zuckerberg reportedly used a GRAT before Facebook went public. Sheldon Adelson reportedly used GRAT to shift over $7 billion with minimal gift tax owed. These are not exotic tools. They are filed quietly every year by estate planning attorneys. Another vehicle is the intentionally defective grantor trust, known as IDGT. This trust allows the grantor to pay income tax on the trust's earnings personally. Paying that tax reduces the grantor's estate further, which itself is an additional tax benefit. The tax payment becomes an invisible gift to the trust beneficiaries. It is legal, it is intentional. Dynasty trust takes this further. In some US states, a trust can last for hundreds of years. States like South Dakota and Nevada have rewritten their laws specifically to attract this kind of capital. Wealth compounds inside the trust, largely protected from estate taxes across multiple generations. Each generation can draw income from the trust without ever fully owning or fully taxing the principal. As Andrew Carnegie observed a century ago, the way to handle great wealth is a matter of structure. The man who dies rich dies disgraced, but the man who arranges his wealth wisely ensures its purpose outlives him. Carnegie gave most of his fortune away. Many modern dynasties choose trust instead. Different paths, same awareness. Let us give you a scenario. Imagine someone built a technology company. Over 10 years, their stake grows to $500 million. They need $2 million a year to fund their lifestyle. They do not sell a single share. They go to a private bank. They borrow against the portfolio at 2% interest annually. The portfolio earns 8%. Net real return 6%. Tax paid on borrowing 0. Year after year, they repeat this. The debt grows slowly. The asset base grows far faster. Meanwhile, a top-earning surgeon earns $500,000 a year in wages. After federal and state taxes, that surgeon keeps perhaps $280,000. The billionaire spent $2 million. The surgeon spent less than $300,000 taxes paid. Similar. This is not a moral judgment. The system produces this outcome. Now consider the death of a founder who held $1 billion in appreciated stock. The original cost basis was $10 million. Capital gains exposure, $990 million. At a 20% capital gains rate, that is a potential $198 million bill. Under stepped-up basis rules, heirs inherit that $1 billion. The tax bill erased completely. Now add a dynasty trust holding that same stock before the founder's passing. The asset never enters the taxable estate at all. No stepped-up basis discussion even needed. It simply continues compounding generation after generation, largely outside the reach of estate tax. Thomas Piketty documented the consequences of this in his landmark book, Capital in the 21st Century. When the rate of return on capital exceeds the rate of economic growth, inequality deepens automatically and inheritance becomes more powerful than effort. Wealth concentrates across generations by design, embedded in tax architecture. This is why a family's fifth generation can remain wealthy without producing a single new innovation. Compare that to a small business owner who sells their company after 30 years of work. That sale is a single fully taxable event. No borrowing bridge, no stepped-up basis, no trust shelter. The contrast is not about effort, but both built something real. The contrast is entirely about structure. Now, this video has focused heavily on the United States, but the pattern is not only American. In the United Kingdom, non-domiciled tax status once let wealthy residents shield foreign income for years. In Singapore, there is no capital gains tax at all, attracting global wealth and family office. In Switzerland, certain cantons allow wealthy foreign residents to negotiate a fixed annual tax regardless of income. In the United Arab Emirates, there is no personal income tax whatsoever for anyone at any income level. Family offices, the private wealth management firms of the rich, now manage trillions of dollars globally. Many of these structures move money, residency, and chases the most favorable jurisdiction. This is sometimes called jurisdictional arbitrage. Wealth becomes mobile in a way ordinary income rarely is. A salaried worker cannot easily relocate their job overseas to save on tax. Capital can move in days. This mobility is itself a form of leverage available only to those with enough capital to make the move worthwhile. At this point, a few questions usually come up. Let's address them directly. Is borrowing against assets risky? Yes, if asset values fall sharply, lenders can issue a margin call. A margin call can force a sale at the worst possible time, turning the strategy against its user. Is the stepped-up basis available everywhere? No. Many countries tax estates differently or not at all. Canada, for instance, treats debt as a deemed disposition, often triggering capital gains tax immediately. So the exact mechanics in this video are most precise to United States federal tax law. Are trusts only for billionaires? No. Smaller trusts do exist for ordinary families, often for far simpler reasons. Protecting a child's inheritance, avoiding probates, or organizing a small business succession plan, for example. Could these laws change? Yes. Estate tax exemptions and basis rules are periodically debated by lawmakers. Several proposals have floated taxing unrealized gains at debt, which would directly challenge this strategy. For now, though, the system, as described, remains the law in most of the relevant jurisdictions. So what does all this mean for the rest of us? First, the insights. The wealthiest people in the world are not taxed on income. They are taxed on realized gains. The primary strategy is therefore to never realize gains until death resets the clock. In the interim, borrow. Use debt as a bridge. Let assets compound untouched. Second, wealth is not just built, it is structured. Trust, entities, and timing are the tools. Benjamin Franklin once wrote, "In this world, nothing is certain except debt and taxes." The wealthy have found a way to make one cancel out the other at the exact moment of death. Third, tax literacy is financial literacy. The wealthy hire entire teams to understand these systems. Lawyers, accountants, trust officers, entire departments exist solely to manage this kind of planning. Understanding how these systems work is the first step to participating in them more intelligently. You do not need to be a billionaire for some of these principles to apply to your financial life. Holding appreciating assets long term, minimizing unnecessary realization events, using legal structures. Even a modest investment portfolio benefits from patience over premature unnecessary selling. Even an ordinary retirement account benefits from understanding when a withdrawal triggers tax and when it does not. These are not secrets. They are available tools used invisibly at scale by those who understand them. Governments around the world are beginning to notice and beginning to respond. Some countries have proposed wealth tax, unrealized gains tax, and tighter trust regulations. It doesn't matter if those proposals succeed or fail. The underlying lesson remains the same for every viewer. The rules of money are written down. They are public. They simply require attention to read. The question is never whether the system is fair. The question is whether you understand how it works. Because in the world of money, what you do not know is not just ignorance. It is a cost you pay silently. Every dollar lost to a misunderstood tax rule is a dollar that could have compounded for decades. And every dollar saved through legal informed structure is a dollar working for your future instead. This is not about loopholes in the cynical sense. It is about literacy in the most practical sense. The wealthy did not invent secrecy. They simply read the manual that came with the system. This is Alpha Fiscal Mindset. Study the system, understand the mechanisms, and build accordingly.